Okay, let's start with the questions. Last time I asked you to solve the questions which are related to capital structure. Question number 8 was to find the proportion, like how much of the asset is financed by debt and how much of equity was financed. So how much of the asset was financed by equity. So it was question that was given as assignment. It's the easiest part that you should have done it, and everything is available here. You just calculate easily. I'm just skipping this part. So I'm going with the question 9. So in exhibit A and B, the current after-tax cost of debt of MBG is closest to, so we need to find cost of debt, which is after tax. We need to use the specific formula, which is given in the capital structure formula. Cost of equity. Sorry, we need to just calculate. I'm just thinking on one something and telling you another thing. I'm sorry about that. So we need to just estimate in here the cost of debt. We need to take into consideration tax issue, and the cost of debt is already given here, which is 8%, the YTM. So it is pretty easy part, which is 8% times tax adjustment, and the tax amount is given here as well, which was 35%. So 8 adjusted to 35% of the marginal tax rate, and that should give you exact the calculation of 5.2, like 8 times 1 minus 35%. That would give you 5.20%. So I'm not going to write it. It's many times we solved this type of questions in the previous chapters as well. So based on exhibit A and B, current cost of equity with capital is closest to, so capital structure has got a cost of equity formula. With a taxation issue, we need to take into consideration, if you remember from the MM proposition, it has been divided into 2 parts, which is with tax and without tax. If I'm not here. So this is the formula that we use, without tax and with tax. So we are using with the case with tax. So the cost of equity, the formula that we're going to use is this one. So this is R0 represents cost of equity fully financed by equity. The return on the equity that fully financed by equity. So we can see here cost of capital if all equity finance, which is 10.33%, and having the formula in mind, we can just estimate everything. So 0.103, it's a cost of capital plus 0.103 minus, sorry, it should be in bracket actually, this formula. And times the tax adjustment and debt over equity times debt over equity, 100 million over 300 million. And that would give you actually, if you calculate, it should give you 0.108. And that shows the answer is B. Question 11, based on exhibit A and B, what debt total capital ratio would minimize weighted average cost of capital? So we need to estimate the minimum cost of the minimum weighted average cost of capital, where it can show the minimized cost for acquiring certain capital and what proportion of debt to equity you should use it in order to have the minimum level of your marginal cost. So the proportion of the debts are to equity are given here, 20, 30, 40, and 50. So we're going to use all of them. It's just straightforward calculation. So with a 20% of proportion. So we use the regular formula of the calculation of the WACC, which is proportion of debt times cost of debt with adjustment tax and proportion plus proportion of equity times with the cost of equity. So this proportion of debt was 20% times tax adjustment, which is 0.75, sorry, 65, plus proportion equity times cost of equity 0.1215. This, everything is given. Cost of equity is given, the tax rate is given, cost of debt is given. So which is 11% if we calculate. Then proportion becomes of debt is 30%. 8.4% of cost of equity, cost of debt plus and that should give us 10.74%. And we do the same thing for remaining two proportions with 40% and 50% using the there's cost of equity and the cost of debt proportionally. And with this, we're gonna have, if you calculate, I'm assuming that I will calculate, I'm not gonna write it, okay? Just let's save the time bit. So with 40%, the WACC is equal to 10.82%. When the proportion of debt to capital is used as 50%, 50 to 50, then the WACC is equal to 38%. So what debt to total capital ratio should minimize the weighted average cost of capital? We can see here that 30% of the debt that is financing the capital, whole capital, would get the minimum of weighted average cost of capital. So the answer is B in here. Okay, question 12 and 13, they are theoretical one and giving up. Like there, you have to think and carefully, like holding operating earnings constant, increasing the marginal tax rate to 40%. What would happen to the debt actually?
Result lower.
Why do you think it will lower? Why
Because cost of debt capital. Because I think that we will have to wait. If we have to pay more taxes, that means that
by formula, tax rate reduces the cost of debt.
Yes, very good. Directly using the formula. Directly using the formula. So the cost of debt after the tax, increasing the tax, definitely your cost of debt will go down. Using the formula, like as our friend mentioned, debt times 1 minus T. If you increase the T, the final result, the cost of debt, will be going down. Increasing T, this will go down. Because there's an inverse relationship between debt and the tax. Okay. I'm skipping, I'm leaving this question to you with the pecking order theory. And who can remind me what was the pecking order theory?
First, the company has to use internal funds because then the company has to use debt and equity.
Okay, so the priority comes internal fund, then debt, then equity. Okay. Coming to the question, which is 14. Okay, I'm not going to read it. I assume that you read all the stuff. So there's a Lindsay White company. CFA analysis was evaluating 5 companies here. 2 companies, they don't have debt, which is fully equity financed. One thing I want to just to remember and know that if company doesn't have debt, which is zero, that means this part will be zero. And the WACC will be cost of equity. Okay? WACC will be, because this will be 1. And if you have cost of equity, this is your WACC. This is, you should keep in mind. This is very important. So in here, as you can see that 10% WACC is calculated for this BEMA and GARP because they have their cost of equity. But these guys, they need to be estimated. So it's a good question, by the way. It's a very good question. I may ask you, please find weighted average cost of capital for the company which is fully equity financed. So the answer is in your hand. You don't have to even do some calculation directly, just provide the cost of equity. Or if cost of equity is not estimated, you need to estimate. And you don't need to estimate cost of debt in order to come up with the WACC for the fully equity financed company. Okay. Based on the proposition with corporate tax, okay, this is key points. The WACC is closest to, so which means that you have to use these formulas, okay, the right side formulas. Okay. Right side of the formulas. So based on the proposition, Aquarius, this company. So was it this? No, we sold Aquarius. WACC is closest to. So we need to find the WACC for this Aquarius. So the one way we can do it is using the formula which is given here, this formula, okay? But as we can see, some of the variables are not provided for Aquarius, okay? Some of the variables are not provided. It's a bit long way to do it. So the easiest part is to go through this formula. So which means that the value of the firm is given, EBIT is given, tax is given. The only what you can search is for the WACC. So you just rearrange the formula, you can calculate the WACC. So in here, we are given, let's work out in here. EBIT is 600. So remember the formula, EBIT adjusted to the tax divided by WACC. This is value of the firm. So VL is the value of the firm is equal to debt plus equity. This is what we know it, basically. The value of the firm generally consists of debt over plus equity. We know what is the debt. Debt is given here, it's 2 million, this one. Debt over equity ratio is 60. Debt over equity ratio is 60. Now we can find what is the amount of the equity. if you rearrange the formula, debt or equity ratio, you can find the equity. So it's just 2 million basically divided by 0.60. That would give you the equity amount, which is 3,333,333. And we can now find the value of the firm, VL, debt plus equity. So 2 million, which is 5,333,000. And so 2 plus 3.33, 5,333,000. This is the value of the firm that we searched, actually, that we are looking for in order to use in the formula that we are given. So 5.333 equal to EBIT, which is 600,000, adjusted to the tax, and divided to WACC. Now we can rearrange the formula to get the WACC. So 600 adjusted to the tax divided by 5,333, that would give you the WACC of this company. Directly, if I calculate 7 point. This is the WACC for the company, which is not fully financed by debt and equity. My question to you, what could be the answer if we use this formula? Can we use this formula, and why not?
We don't have returns on debt and equity separately.
So we lack of the information. We lack of the information. Okay, for this company, for this specific company, we don't have it. That's the main reason. Like cost of debt, we don't have the cost of debt. Okay. Now, let's proceed with the question 15. Based on MM proposition with the corporate tax, the BEMA's weighted average cost of capital after the completion of the announcement debt finance share repurchase program. So if we look to the table for the BEMA, we don't have either. Okay. If you look for the BEMA, we don't have either the calculation. And we only have cost of equity. We have a cost of equity. Who can tell me what is the BEMA's cost of equity? If all equity financed?
10%.
10%.
10%.
Easy as that, yeah.
Yeah. Now, in here, we have to use the formula because all the other information for the BEMA is given as its announcement tells you. Look, it tells you directly in the question that here we have BM proposition weighted average cost completion of their announcement debt finance share repurchase program. Okay, in the announcement, in the BEMA, they say it directly. So BEMA has announced that they will issue the debt in order to repurchase some number of the shares. As a result of the debt finance projects, I'm sorry, repurchase program, and BEMA indicates that debt equity ratio will increase to 0.6. So all the necessary information is given here. So for us, it's better to use the formula which is given here. So we will use this formula. So cost of equity with the consideration of the debt financing. The formula which was given in the slide, we are using this 0.10% plus 0.10 minus the cost of debt, which is 6%. And it is adjusted to the tax and times by debt equity ratio, which is given as well in the announcement part, 0.60. And the cost of equity would be equal 0.1168. Now is the turn to use the formula, the normal formula that has been given to you in the cost of capital chapter, which is proportion of debt times cost of debt adjusted to the tax and plus proportion of equity times cost of equity. So we will just substitute into that formula and we will be able to estimate. And WACC is here. So proportion of debt is estimated through the debt equity ratio, as we know from the previous chapters, is debt equity ratio divided by 1 plus debt equity ratio. That would give us proportion of the debt, which is 0.60 divided by 1.60. And it's timed by the cost of debt. It is adjusted to the tax, which is 70 plus let me just estimate this part. To calculate the proportion of equity. Proportion equity is estimated through 1 minus proportion of debt, and proportion of debt is 1.6, 0.6 divided by 1.6. It's 0.37, 0.375, and 0.625 times cost of equity that we found it, 0.1168. And that would give us weighted average cost of capital equal to 8.88%.
Professor, question?
Yes, please.
So where did you get 1.6?
1.6. In order to estimate the proportion of debt, if you remember from the cost of capital, it's debt equity ratio divided by, let me just take this bracket. Come on. Divided by 1 plus this debt equity ratio. That would give you the proportion of debt. Okay?
Okay, yep, thanks.
And you can do the same thing with the proportion equity. In the way we can divide 1 divided by 1 plus debt equity ratio. That would give you the proportion equity, or 1 minus proportion of debt. The easiest and fastest way.
Yes, thank you.
Okay. Question 16. I will skip it. It's theoretical. 17. It is similar to the question 15, but for the GAF cost of equity for the GAF company, I'm not going to do it. I will move to the. So I will stop in here for these questions because question 17 is similar to the question 15. It's solved in the same way. And questions 16, 18, and 19, they are theoretical one. I'm leaving on your shoulders. You can manage it. If you have any questions, you feel free to ask me. But I would like to move to the chapter which is next one, dividend and share repurchases.
Excuse me, Professor, may I
Yes,
ask a
please.
question about dividend discount model, about
Yes,
DDM?
sure. Sure.
Because we've got the examples and we've got the next year dividends, but I don't remember how we solve it when we have current
Okay.
year dividends.
Okay. Here, this is the exam question, okay, that you had it. You were given the dividends, the current year dividend, which is 2.5. And in order to find the D1, is D0 times 1 plus G. To find the D2 is D0, 1 plus G to the power 2. Or if you're finding through the D1, D2 is equal to D1 times 1 plus G. So G is here, we estimate through this formula, dividend payout ratio and return on equity. And D0, it was given 2.5, which is 2.5 multiplied by 1 plus 8.5%. That gives you D1, which is 2.5 multiplied 1 plus 0.085. So it gives me 2.71. That's a D1. Okay. Is that the question that you were asking?
Yes, it's I was asking about current. Yes, it's current dividend. Yes, thank you.
But what if it's D2 given to you? In order to find the D1, is just through the reciprocal model, which is division, D2 divided by 1 plus G. In order to find the D1.
Okay, thank you.
Okay.
Thank you. I've got. I want this formula. Yeah, thank you very much.
Okay. By the way, this is the makeup questions. Of course, I'm not going to open it to you, but you may feel curious about it. Best of luck.
Thank you.
Thank you very much.
Thank you.
Okay. Yes. You want to ask some question, Tamerlan?
Yes, I wanted to ask some question.
Shall I open the makeup question to you?
It is not regarding to exam, but can we write? But no, it's regarding to exam. Can we write it by hand on the paper, just on the paper, and take a photo for you? Because
Yeah,
in some
yes,
cases,
yes, of course. For example, the main reason, Tamerlan, the main reason why I was asking you, this was the main reason behind why I was asking everybody to submit their papers. You could easily select the right answer. Even there was one student, I don't remember who wrote me. He said, by mistake, I selected correct one. So he did not solve it, but he selected correct answer. So I want to see who got the full, and I want to see how he got this full.
Okay.
Okay, this is the main reason.
Yeah.
Somebody could just easily predict the answer. That's it.
Okay.
Okay, this is the main reason why I want you to.
I'm not a lucky person, and I cannot take a correct one. I tried it so many times, but I'm not lucky. I understand it. So
Okay,
I need to.
okay. The luckiness is not about you, yeah?
Yeah, lucky is not about you.
Okay,
Prediction
no
is not about you, me. It's not about me.
Okay.
Excuse me, Professor. May I
Unfortunately,
ask?
this is the life.
Yes.
Cruel.
Excuse me, Professor. May I ask if I've got like question like DOL DFL, like which we've got in a quiz when we have in a different places the answers.
No, I don't ask you anymore. Yes.
Yeah, but I've got the correct answer in my solutions, but I didn't. But I've choose the wrong one. It will be counted or not?
As I told you, I will look into this case. I will look into this case.
Okay. Thank you very much.
I will look special about this question.
And in some question, in the last question, I remember that the table was not visible for us.
Okay, I
So
explained.
What do we need to do? We need to zoom
out. Zoom out.
Just zoom out it, and that's
Yeah,
all.
just press Control on the computer. Just press Control And on
Okay,
the
got it.
mouse, there's a
Okay, I know
scroll.
about. Okay, okay,
Just zoom out, and zoom in. You'll just get exactly the same table. It was like this.
okay, okay.
Okay. Coming to the chapter 6, which is dividend and share repurchases basics. In here, first 5 questions, they are theoretical one. I'm leaving to you, but they're very simple. Like, for example, the payment of 10% stock dividend by a company will result in an increase in the company's current ratio financial. We know that the stock split, stock dividend, stock repurchases, they do not affect the current ratio, the liquidity. If it's written in the last slide, if you remember. The slides. Yeah, sorry. It was somewhere here. I just got it. Okay. Stock dividend, stock split, and reverse stock splits have no effect on the company's leverage ratio and liquidity ratios. The transaction do not change the value of the company's asset shareholders' equity. And it's really proven, and it's provided as a proof to you from this calculation, as you can see it, stock split and stock dividend. Okay, this type of question are asked here, question 4, and this is question 5. It's chronological chronology of, or the system of the payout policy, how it works. You have to just select the right, you have to match right answer. Like, what comes first? Question 6 same, question 7 same. So until 7th question, they're all theoretical one. I'm leaving on your shoulders. If you read the slides, you will understand better them. If you have listened to me carefully in the previous class, then you should not have any questions regarding these theoretical questions. But still, if you have any questions, please feel free to get in touch with me without any hesitation. I will be very glad to help you. But before I forget, yes, I almost forgot it. I'm locking our meeting so nobody can enter, so that I can take the attendance. Muhammad Ali. Arnay.
I'm here.
Aljan.
I'm here.
Okay. Arimjan. Somebody is writing me. Wait. Hyunjin Kim, Professor, my mic doesn't work, but I'm here. I hope your headphones are working as well. Bernard.
Here.
Oljas. Oljas here? No. Awel. You're not?
Yes, I'm here.
Din Muhammad.
Here.
Aidana.
I'm here.
Kim is here. Adil.
I'm here.
Yer Sultan. Madina.
I'm here.
Ademi.
I'm here.
Laura.
I'm here.
Diana.
Here.
Ehram here. Begzat Saylav.
Here.
Baljan.
Here.
Nuray. Komil. Tabit. Kormet is not here. Temirlan.
Here.
I'm here, Professor.
Temirlan here. Temirlan here. I can see him. Nurgul. Nurgul. Okay. Great. Now I can unlock the meeting, so now everybody can join, whoever did not join before.
Professor, I have a question.
Yes, Adil.
The last example you explained us about the current year, but I still have the wrong answer in Excel.
Okay. You mean this one?
Yes, I have 16.33.
This is if I, for example, I had different answers. You have a correct answer, okay? I just changed it to the D1 because in some question, other questions, I asked different questions. So for somebody, I gave like current year. For somebody, I gave as a next year dividend. This 2.5. Okay, I was just mixing up. But the correct answer, if it's this, is this. But I might change. I have changed for somebody. I made it this one not current, but the next year's dividend. And if he copied, he has not realized that it was the next year's dividend. He just copied directly straight away. But correctly for this question, the correct answer is this.
Okay, thanks.
Professor, how did you find the return on equity?
What did I find? What?
Return on equity, ROE.
Return on equity is net income over total equity.
Divided by.
We have here
Yes.
net income and market value of equity. It's straightforward calculation.
Plus
And
retained earnings.
how did I find the payout ratio? Do you know that net income is equal to payout ratio plus retain additional to retained earnings? If this is given, can you find the payout ratio? Easily, isn't it?
Professor, but the problem is that we were not given that on the presentation. Yeah, on your lecture
In the
slides.
class, I taught you, this is the accounting course, first of all. In financial management course, second thing. And the third, if you search through my videos that I explained, I had this example already in explaining DD model. If you go through the Moodle, even it's not in the presentation. In the presentation, you are not taught how to add 2 plus 2, isn't it?
Yes.
So these are the basic things that you have to know.
Can you repeat, please? Net income is the payout ratio plus additional to retained earnings, right?
The logic is what, guys? There is a net income. This is the bottom line of the income statement. It is paid to the dividend holders.
Yes.
To the shareholders, I'm sorry, that's dividends. And the remaining part goes to company. It will be retained back to the company. This is accounting principle in the income statement. So if you have $100 of the income, $30 goes to the shareholders as dividends, $70 will be kept in the company. If this not given, how can you find it? This minus this. So this is the basic things. I mean, in accounting principles. This $70 goes as additional to retained earnings. Retention ratio, dividend payout ratio. And ratios are found in this way. 70 divided by this, which is 70%. And automatically, remaining part will be the retention ratio. So I'm very sorry, payout ratio.
Yes, got it. Yeah, yes, it was in accounting course. I remember. Yeah.
Okay, thank you so much. I'm really happy that you remember.
Excuse me, Professor. So if we need to find current year, if I'm right, we have to find D1, and if we've got next year, even we will find D2. Yes, if I'm not mistaken, because I've got a little problem with this because next year is D2. Yes, we have to find.
In this type of questions, you need to find only D1. If D2 is given, how you can find the D1 is D2 divided by 1 plus G. If your D0 is given, how can you find the D1? Is D0 times 1 plus G.
Oh, okay, okay. Thank you. Understand.
Okay. Okay, let's move to this question. In this question, a company has got 1 million shares outstanding and earnings are 2 million. The company decides to use 10 million in idle cash to repurchase shares in open market. The company's shares are trading at $50 per share. If the company uses the entire 10 million of idle cash to repurchase the share at market price, so the company's earnings per share will be closest to after the buyback. So we need to calculate earnings per share in here. First of all, we need to find out how many shares will be repurchased. We know the amount that will be repurchased. Number of the outstanding share we know as well. We know that using this 10 million of dollar cash, we will repurchase the shares. But how many shares? So 10 million divided by the price per share, that would give us, so 10 million divided by 50, that would give us 200,000 shares will be bought back. How many shares will be outstanding after the purchase? Like 1 million minus 200,000. So outstanding shares after buyback will be 800,000. This is what we know. And earnings per share before buyback will be, so EPS before buyback will be the earnings, which is 2 million, divided by the number of the shares, which is 1 million. So which is $2 or 2 pounds per share. And after repurchase, the number of the shares outstanding will be reduced to 800,000. And EPS, earnings per share, will be differently after the repurchase. So EPS after buyback, which is 2 million divided by 800,000. So your EPS will be 2.5 pounds per share. So from the answer, you can select C. Okay. Question 9, 10, I'm leaving to you. Why? Because it's given in the slides directly. You need to just compare. It's not about the slides. It's all about the slides. These rules, okay, you should know. If after tax cost of debt is less than earnings yield, which is EPS over price, then EPS will increase. So you use these formulas to compare. It's a theoretical one. So you find the earnings yield and compare with the after tax cost of debt. Then you can understand what happens to the EPS. In here and the same, okay? 11, its corporation plans to borrow just enough money to repurchase 100,000 shares. So they will repurchase 100,000 shares with the full information like outstanding shares before buyback, earnings per share before buyback, and share price at time buyback, and after tax cost of borrowing, which is 6%. So we are asked to estimate the EPS after buyback. We are asked to estimate EPS after buyback. It's exactly the same that we did with the question 8, but let me do it. It's a bit challenging because it's got some depth issue. So total earnings before buyback, total earnings before buyback is equal to So $4 earnings per share times number of the shares outstanding, which is 3.1 million. So which is 12,400,000. Total amount of the money that you will borrow to repurchase the shares. The number of the shares you will repurchase 100,000 shares, and the share price is $50. So debt is equal to 100,000 shares times $50, which is 5 million. Number of the shares outstanding after buyback. Shares after buyback. Shares after buyback. We had 3.1 million minus 100,000. So which means that you will be end up with 3 million shares of outstanding. And of course, to calculate the EPS, earnings per share, after buyback, with the interest cost. And one thing I forgot to estimate in here, I need to estimate the interest cost as well, because interest cost is involved in here as well. The cost of borrowing, which is 6%. So the cost of borrowing, which is 6%. So the cost of borrowing, so it is 6% of 5 million, which is 300,000. And earnings per share after buyback is equal to total earnings minus interest cost, and this all divided by the number of shares outstanding after the repurchase, which is 3 million. And EPS after buyback is equal to 4.03. So if you want to compare, let's say, if you want to see what will be the earnings per share in here, before the buyback it was $4, and after the buyback is 4.3. But before the answering whether it will increase the EPS or decrease, you can just refer to the slides where the rules are written here. As you can see, if the after-tax cost of debt is more than your earnings yield, then EPS goes down. If after tax the cost of debt is less than your earnings per share, less than earnings yield, your EPS is expected to go up. So we can just do it and see what happens. Let's try it, whether it matched with our answer or not. So EPS over the price, earnings per share is $4 divided by 50, 4 divided by 50. If you just estimate, it should give something for 8%, okay? And cost of debt, which was 6%. So we can compare, we can say that 8% is bigger than 6%, which means that if earnings yield is greater than after tax cost of debt, then it must be the case that EPS or earnings per share will go up. If the vice versa take the place, then you could say that earnings per share will go down. Okay, actually we are left question 12. 13. There are two calculations. They're big calculation, but I want to stop here. I will leave it to Wednesday. We can meet on Wednesday so we can finalize everything without any rush. Now, if you have any questions, feel free to ask. If not, thank you so much. See you on Wednesday.
Okay, thank you, Professor.
Thank you.
Sorry, Professor.
Yes,
I have a
please.
couple of questions regarding calculation of some problems.
Yes.
So can I ask them after the class, or maybe we can make a separate meeting for it today?
Today, right after the class now, if it's very long questions.
No, it's not. It will not take much time.
Okay, then ask now. Ask now. I can stop sharing the screen so that you can ask the question directly.
Thanks, you.